Good afternoon, everyone. I see a few of you are joining here. Thank you for joining. My name is Blessy Thomas. I'm going to ask for those of you who are on the call that are not presenting, if you could go ahead and mute your lines. We want to make sure that we have no interruptions during the call so that you can hear the content clearly. And we're also recording this content for your reference later. So we just want to make sure it's available for you at a later time when you're looking for it, okay? So we'll give it a few minutes. We have a substantial number of registrants for today's call. So I do anticipate a lot more people to jump on here as we get closer to the hour. So I'm going to give it a few minutes post 4 o'clock just to give them a chance to dial in, and then we'll get started, okay? Actually, for those of you who are on the call, if you don't mind, if you are willing, if you want to go ahead and in the chat, just put your name, your business name, and the industry that you're in so that our presenter gets a sense for who's in the audience. I did share a little bit, but it might be good for him to know who's actively here today. Great. Thanks for those of you who are jumping, sharing that. Gonna wait a little bit more. We'll give it another minute. And for those of you who are not presenting, if you could go ahead and mute your lines, that would be great.
Hi, Blessy.
Hey, Dom.
Hi, how are you?
Doing well, how are you?
I'm doing well, thank you. It's good to see you. Happy New Year.
Happy New Year.
Yes, thank you. Will you be sharing these slides afterwards?
Yeah, we are recording the call, so you guys will see, have the questions that are addressed as well as the presentation to view.
Perfect.
All right, so I'm going to keep letting people jump in, but we're going to go ahead and get started. I just want to welcome everyone. Thank you for taking the time. We know your schedules are busy, but these things are also important to address in your business strategy and growth strategy. So thanks for allocating the time. We really look forward to the discussion today. So let me introduce myself. My name is Blessy Thomas. I am the project director for the MBE Equity Multiplier project. For those of you who may be wondering what is that, let me just give you a little brief overview. The MBE Equity Multiplier project is an award that we received through MBDA. The focus of the project is really the overall goal is to help minority businesses prepare for the equity investment market, and then post doing that, really the focus would be to connect you to as many of you to equity investors. So the overall objective is to better connect MBEs to the VC and PE ecosystem. So that is our goal. There are kind of multiple lanes of what services we offer based on where your business is and where you are in the journey. Some of you may be very new to this, to the lingo and to the market and to the world of equity financing. So you might be just looking to learn, get the baseline things down. And so for things like that, you can definitely take advantage of the workshops. Don't hesitate to reach out to me, take advantage of some of the resources on our webpage. But many of you are probably in the stage of saying, you're generating revenue or you're working on a product idea and have some level of a beta and starting to trying to go out to market and so on. You're probably in the process of saying, I definitely know I need equity financing, but I need to work on my package. Or I know I need equity financing, but I have a package, but I need somebody to vet it out and help me kind of prepare better for my investors. And some of you are already, have raised funds and maybe looking for the next tranche or additional funds. And so we have businesses that are in different stages. So there's different things that you can take advantage of. For the first group that I mentioned, like I said, please take advantage of the workshops, tools and resources on our webpage, and don't hesitate to reach out to me directly. I'll provide that contact information later. And for the rest of you, there is actually a whole suite of one-on-one services that we're offering with consultants. So we have financial analysts in place and an investment readiness coach in place who are actively working with businesses right now, delving into their investment packages, vetting their financials, valuation, revenue models, and then really coaching around really understanding their business, but then coaching them around how do you really draw out the strengths of your business and what do you really want to be aware of when it comes to presenting in front of investors? What are they going to see and notice or have questions around that you want to best prepare for? So we do have those one-on-one services, and the way to engage with that is really by going to our webpage and completing our intake form. I'll provide all that information at the end. But I do want you to have a sense for kind of the full suite of services that we offer. And if you want to talk through any of that, don't hesitate to reach out to me. So with that, I don't want to delay any longer getting into our presentation for today. If you have, obviously you all are looking to learn something around this topic, but we have two sessions. Actually, we have two sessions around the topic of developing a solid investor deck. Today's is focused on an audience where the business is in the pre-seed, seed, early stage. Tomorrow's session at 4 o'clock is focused on businesses that may be in the growth or later stage. So meaning, established business generating revenue for multiple years, has recurring revenue coming in, has acquired contracts, and maybe is looking to grow the next stage, maybe scale, invest in technology, invest in leadership, executive talent, so on. That would be kind of how I would kind of a simplified way describe that audience tomorrow. You are still welcome to attend that session tomorrow. So I'm plugging it still if you want to learn for the future, or if you have other counterparts or other entrepreneurs who would benefit from that, please do refer it on. So let me introduce our presenter for today. We have joining us Samer Youssef, who he's got multiple hats he wears, actually. He's Chief of Staff at Black VC, as well as the Managing Director for the Investors of Color Network. I've had the privilege of getting to know Samer as we've been working through some of this content together. I'm going to ask, if you are not presenting, can you please put yourself on mute? Thank you. And so we've had the pleasure of getting to know each other a bit through this process, and I've been able to join some of the calls in the Investors of Color Network, and it has been great to kind of hear what's going on there. So I am actually going to hand it off to Samer to give a more detailed introduction on his background. And thank you so much for joining us, Samer. Pass it on to you.
Thank you, Blessy. I appreciate the introduction and inviting me to speak. Also, Happy New Year's to everybody here. It's a pleasure to meet y'all and looking forward to connecting. As Blessy mentioned, please do just drop your name and industry in the chat. She sent an overview in advance, but would love to see who else is on the call. So quickly about myself, Samer Youssef, as Blessy mentioned, I wear a few hats. I'd say my day job is I'm chief of staff at Black VC. It's a nonprofit organization focused on making the venture capital industry more diverse and inclusive, specifically increasing the number of Black venture investors, advancing their careers to become check writers, and ultimately expanding the amount of investors, assets under management, and capital flowing within the Black community as a tool to build wealth for the broader community. And really, that's kind of like looking at the other side of the conversation. It's oftentimes comes up about the lack of funding for Black founders, really trying to solve the question on the capital side. And the other hat that I wear, I'm managing director of Investors of Color. It's a consortium of Black, Latinx, Asian ally investors investing in what we call the health, wealth, and social mobility of communities of color. It means we invest primarily seed, Series A into fintech, edtech, enterprise SaaS, digital health and wellness companies that may be founded by founders of color, but ultimately should be adding value to those communities. So happy to talk offline about either of those things or follow up with anybody that may be interested, but we'll go ahead and dive in. I want to just a quick logistical note. Please do drop any questions you have in the chat as they arise. And I'll be keeping an eye on the chat, but Blessy as well will ping me if something comes up to pause. Definitely want this to be more interactive versus me just kind of speaking to you. So the more relevant I can make this, the better. So just as a quick overview, the things that we're going to be highlighting on the call today, and this also encompasses the main points that were included in the the overview doc that Blessy shared with y'all in advance, but really I want to first level set with everybody to get on the same page. What are we talking about? It relates to pre-seed, seed, early stage capital, and then kind of quickly walk through the different elements that should be included in a deck. Again, these I think I would say are building blocks, but obviously each have your own nuances, and as I heard from the beginning, are at different points in your journey. So those that are maybe just starting out, really starting to build out their team and develop their business model, those that have traction, have revenue, and are looking to access equity investments. But this is just a starting point, and happy to answer any questions as we go along. All right, so what is early stage capital? And I linked there when you get the doc, this is just a quick link on overview of what early stage capital is. But predominantly when we're talking about this is equity-based investments. And I'll talk about the kinds of notes that they are, but there's really generally two rounds or sections of early stage capital that people think of, and that's pre-seed and seed. And those delineations have become way more fuzzy, I would say, over the past 5 years, but especially over the past 2 years, where just there's a lot of more capital in the ecosystem. Companies are being invested in much higher valuations. And so the line is being blurred. But with pre-seed company, people are typically talking about this as you've just developed the idea, you're starting to build the business model around it, maybe you just incorporated. And this is oftentimes the capital you get that's the first money in. A lot of times it's money that you're putting in into the company, maybe friends or family. Historically, people would have thought of this as like 250 and below, but I'm starting to even see, pre-seed rounds where people are raising $1 million. But generally, this is kind of that early stage group. You really don't have a product yet. You don't really necessarily have traction. People are just betting on you. They're really smart, very well-connected individuals. And they think that you'll be able to build this company. And the seed round is really when you start to introduce external pools of capital. So this is when you probably have your founding team in place. You're looking to raise, people really range from 1 million. I've seen from like 500,000 up to like 3 million to recently we looked at a company that was raising a $5 million seed round. And this is, generally speaking, this was in the space where angel investors were primarily investing in. And this is a quick definition. Angel investor is a accredited investor as defined by the SEC. Somebody having, I think it's about $200,000 in income over the last 2 years, 300,000 for a couple, or over $1 million in assets less the value of their home. And they're able to make private investments into companies. This is primarily where angel investors were playing for a long time. But over the last 10 years, especially the last 5 years, you're seeing a lot more venture capital funds starting to come in at this early stage. And some are even starting to play at the pre-seed level as well. And so the typical investment vehicles that you're seeing at this, and I didn't include an additional one, which it kind of will fall under the general, I would say, kind of purview of what a convertible note is, although they're fundamentally different vehicles. I didn't want to confuse this conversation with a safe note, but the two main ones that you'll probably come across is a convertible note. So a convertible note is a debt instrument. So it's essentially a loan in which you are saying to an investor that, I'm an investor raising with my company. I need to raise $500,000. An investor comes to me and says, okay, I'll give you that $500,000 in a convertible note. And that debt will convert into equity at the next price round I have. So a lot of times you see the reason why these are popular at the earliest stages is that, one, they're very cheap from a legal perspective to develop. Two, you don't have to agree on the valuation at the point of investment. So it's very difficult to value a pre-seed company. There's just an idea and a few people working on it. But what a investor will say is like, I'll give you the $500,000, but I need some incentives for taking this higher risk this early compared to the next price investor, right? So I want to get a little bit better terms in the next round because I'm taking a risk when you really don't have much. And so that incentives is called a cap and a discount. And so a discount, a traditional one you'll see is maybe 10 to 20%, which all that means is, say I raise this $500,000 and I go out and raise my next round, I raise $5 million. So now technically that $500,000 would be worth 10% of my company if that person was to invest at that subsequent price round. But because the investor invested in me today versus 2 years from now, they took a lot more risk. They want a 10% discount on that. So which means that they're really investing at 450, 4.5 mil at the valuation of 4.5 mil, which essentially would mean the percentage, that $500,000 that they put in would actually be worth more of the company, right? Would be worth 10% more of the company because they took that initial risk. So that's what a discount is. A cap is essentially saying, I'm investing at I'm giving you that $500,000. I don't know what the next valuation is, but if it's anything above $5 million, my debt is going to convert into equity at $5 million, right? If it's lower, if it's 3 million, it'll convert at 3 million. But if it's 10 million, it's converting at 5 million. And what that does essentially says, if you do raise around at $10 million, they don't get diluted, right? They still get 10% of the company regardless, right? And so a lot of times with these convertible notes, you see both. And it's one or the other. Both can't activate at the same time. So convertible note may be like you have a 20% discount with a $5 million cap. And essentially whichever amount is lower, that gives you the higher percentage ownership of the company is the one that you're going to go with as the investor is going to receive. So those are the two kind of just different structures. And there's much more complexities to it, but that's just at a higher level, just understanding that. And yeah, these are very common in pre-seed and seed rounds. Although you're starting to see a few more priced equity rounds at the seed stage. And that's what I'll convert to next. And this is a purely equity investment, right? So they're giving you a certain amount of capital for a certain number of shares at a pre-agreed upon valuation. So in that initial question, it's, like that $500,000, I'm coming in and saying, your company's worth $5 billion, I get 10% of that company. That's going to be preferred shares. And really that's the difference between preferred shares and common shares is that on the downside, say your company at the point of like exit, which we'll talk about a little bit later, you don't return back the entire capital. They get their money first. But Blessy, I saw you unmute. Did you have?
Yeah, so I mean, I think we could probably jump into some of the content, but we did have a question, which I think we can table, but I do want to put it out there. I think we had a question on how do you partner with an angel investor? So I would say, Summer, if you want to hold that off for one of the areas later, feel free to do that, or if you can address it
Cool. Yeah, I think, we can talk about just fundraising from angel investors, building relationships down the line. But generally speaking, I think approaching an existing angel network is a good way to start to source capital and meet a variety of different angel investors. But I'll go ahead and jump forward, and I'll go somewhat quickly over this, but feel free to ask questions or Blessy, please pause me if I'm going too fast. What was that?
We should be good. Yep.
Okay, cool. So company interview. Now when we're thinking about the deck, really the two key areas that you need to highlight when you're building out your deck that investors want to look at is what exactly is the problem that you're solving, right? So, what is the issue and for whom is it affecting? I'm creating a solution for better account management for accounting firms, right? And this problem is significant for accounting firms because they're spending at least 10 hours a week managing a lot of their different accounts. That equates to, X amount of dollars they're spending on admin a month, right? So that is quantifying that problem very specifically. And then you also should include the last piece that I included was what are they doing to solve it, right? So in that case, they're paying some sort of admins or part of their staff time is going to solving this problem. So you're quantifying it and you're also identifying who specifically is facing this problem and making it clear why it's significant. Then the other side of it is what is your solution or your value proposition, right? Why is the thing that you are building specifically going to solve this problem, right? And you can talk. We'll talk a little bit later about the competitive analysis and things like that. But really, you want to be able to clearly articulate why this solution is better than other existing solutions. Why this is better than whatever other software for account management is out there for accountants or whatever it may be. We got a question in the chat. Issue for us right on the stage. So we could talk about valuations a little bit later. We'll actually talk about it a little bit from exit planning, but my initial response to it is a lot of times you want to look at the market, right? So if you're raising if we're using this example of an account management software, you want to look at the market. What other companies have been raising that other accounting kind of service softwares are raising capital? At what valuation were they raising their pre-seed or their seed? And you could try to model your fundraise similar to these other companies, because then you can point to the market and say, I can validate that I deserve this kind of valuation because my solution is actually a little bit better than theirs from where they were at their pre-seed. So a lot of it is looking at the market, but there's no science. It's a negotiation every single time. And it's really just about how you're able to kind of approach that conversation with the investor. So now the next biggest thing investors really want to know when they're looking at any deck is the target market, right? And the thing you'll always hear is kind of thrown around all the time is a TAM, SAM, and SOM, right? And so the total available market, is continuing this, example is all of the accounting firms in the world, right? This number, the TAM, is nobody actually ever hits this. And this is kind of speaking purely from kind of people can think about it from a market cap perspective as far as the value of all the companies, but more specific is more helpful is usually just the spend, right? How much is actually being spent on an annual basis across all accounting companies, right? For administrative services. That could be the TAM, right? This is massive number that realistically nobody's really going to hit, but you want this in the billions of dollars for it to be interesting for investors. Because specifically what they're looking for here is they want to know that if your company was to scale, right? So if you were to succeed on all your milestones and really reach a point 10 years down the line, the market is big enough. It's a multi-billion-dollar market that you can sell your company or IPO, and there'd be a massive windfall of capital returning to them, right? So the bigger the market, the better. You usually hear them saying a minimum $10 billion market is what people talk about. The TAM really, though, this is just a very massive amorphous kind of thing. You can get it from a lot of industry reports to get more fundamentals. Serviceable available market, this is a little bit more narrowed down, right? So when I was talking about previously the world, the SAM could be, say, the United States, right? And that's a much smaller market, but it's also much more technically reachable if all of you are in the United States. And then the SOM this is really that most attainable market, right? So you could be talking about small to medium sized accounting firms that are between 5 to 25 employees that are doing, averaging, 100 clients total with an X amount of revenue within the Mid-Atlantic region or something, right? That's a much smaller pool. And as you can see from the little chart, it's smaller, but what that says, like, that is kind of like indicating your first beachhead market that you want to be able to dominate. And then you dominating that will allow you to expand into that SAM, which then touches the broader the United States, as well as different size accounting firms within that. So the competitive landscape. So this slide and this little presentation is one, like this little animation is one that I like seeing in a lot of decks, and I see it pretty often. And it's a very simplified way of essentially showcasing why your company is better than the other competitors based on the value propositions that actually matter to your customers. And that's the most important piece, the value propositions that actually matter to your customers, right? So first is like, to do this, you obviously want to do a competitive landscape. And there's some questions you have to ask yourself here. So it's like, okay, who else is doing this work and serving my my customer segment, right? Two, how is the market's kind of like structured? Is it highly fragmented? We have a bunch of very small companies that are servicing this, and each of them own 5% or less of the industry. Or is it heavily consolidated, right? And you have maybe 3 big players, each owning like a fifth to a quarter of the industry, and it's really hard to break in and to kind of set your stage. So calling that out up front is very important because it showcases your deep knowledge of the industry. But then you want to go down deeper, right? And the key value propositions here could be a variety of different things, right? So like continuing with this metaphor around like account management platform, one key value proposition or say problem that you're solving for your customers is that the existing solutions that these other companies are doing aren't integrated into the rest of their systems, right? So maybe these accountants use QuickBook and they use a variety of different accounting software, but that account management software is not integrated into the all of their systems. A second piece could be it requires a lot of manual input, right? It's not automated. There's not like a strong AI back interface or whatever. So it requires a lot of time for them to manage. Third, it could be expensive, or it could have like a minimum threshold of like clients that a typical accounting company may not have, right? And so if you were to, those 3, value propositions that I mentioned, if you were to highlight those, key value proposition 1, 2, and 3, and we'll just throw in a fourth of just saying speed, just they're much slower in their integration. Ideal here is you want to showcase the reason why you are better than all the competitors and you'll beat them and take their customers from them essentially is because you are able to service all the needs of these of your customer segments in a way that your competitors can't. And easily visualizing this in a deck is a great way for investors to kind of see it as they go. Because one thing like investors are notorious for is skimming. They're huge skimmers. They just like go through decks like quickly. So the more visualized representation you can include there is key because they know exactly the data points they're looking for. And you'll have the follow-up information you can include in the appendix about much deeper, information like the market share for each client or for each competitor, or like, more specifics about differentiation. But on this slide, it wants to be simple, high level, and clear. And then you want to just ensure that the key value propositions and differentiators you're selecting are actually the most important ones to your customers. Because if you have an investor that's pretty, deep in the space, they'll be able to call out pretty quickly whether or not what you're saying is true. So the team slide, and this is very important, and especially at the pre-seed and seed level. As I mentioned, like typically companies are coming in pre-product, pre-revenue. At the seed, they might be having a beta, they might have a pilot, they might have a little bit of traction, but fundamentally what people are betting on here is you, the founder, right? And a metaphor people like to always use is like they're betting on the horse, not the jockey. Sorry, the jockey, not the horse. So the horse is probably kind of slow. It's probably not that good. it's probably might be a little bit young, too young to like win races or whatever it may be. But what they're investing is, as you as the founder have the knowledge, the expertise, the network, the ability to learn, to be able to take this product that looks kind of ugly and is still kind of early. Not to say anybody's businesses or ideas here are ugly, just talking generally speaking as far as like early stage companies. But you will be able to take that and transform that into $1 billion+ company, right? And being able to highlight who that founding team is and specifically what accolades they have that will make them differentiated, essentially from they have that differentiated from another team of people that could be also doing this is key, right? So I have a sample slide after this that shows a little bit of just like, it's a bit satirical, but hopefully it'll give you the idea. And it's kind of just like talks about the key accolades, roles, that person's responsibility, why that person is the right person for that role. And then additionally, because it's going to at the pre-seed and seed stage, it's oftentimes just the founders. If you're a sole founder, it might just be you on the team. And so you want to be able to showcase the advisors, the board members that you have, and specifically what access, advice, and things that they can provide that'll help you grow. Blessy, did you say something? I thought I heard something.
Sarah, would you say, can you show people on the team that are not immediately directly working on the business? So, if you're consistently getting advice from a group of people in the industry, would you consider that a team or part of the team, or is there a way to present that? So, especially in the early stages when you can't be affording and when you cannot afford to have those high level executives on the salary. Yeah.
100%. That's a good point. I think advisors, showcasing advisors, if you have them as board members, that's also an option, but that's something I see all the time in pre-seed to seed decks, right? And honestly, at all stages, you see them. So like, most recently I was looking at a company, it was a Gen Z fintech startup, right? Focused on educating Gen Zers on like financial literacy, but then it was also, they had a product where they can essentially invest alongside key like influencers in the industry. But their go-to-market approach was student athletes, right? Because for those of you that know, student athletes now are able to make money off their likeness, make money off the fact that they're being student athletes. And so they're using student athlete ambassadors at different universities to be able to reach out and like engage different like populations. So on their deck, as some of their ambassadors / advisors that they had athletes, right? And pretty well-known collegiate athletes. If y'all are into college football, a few of them I'm sure you'll know. But in addition, they have two well-known NBA players, one that's recently retired, as advisors, right? Who also came in as investors, but they were advisors. And so on their team page, they also had these people, and it was this delineation. There was like the team, and then there was a new page for advisors. But that's definitely how they were able to kind of like leverage those brands to put in. I would say though, you definitely want those advisors to opt into being in the deck. That's definitely the most important thing, because, and I've seen this actually happen before, where somebody said they were advisor to somebody that I knew. So I reached out to them about the company. They're like, "Oh, we had a call like 3 months ago. That was about it." And I was like, "That's so you don't want to kind of get flat-footed, because the follow-ups and the due diligence, hopefully that investors are doing, we'll call that out."
Yeah. And we have a good question from Alberto in the chat that says, yes, what about the use of consultants that have been part of your product building? So I think that's a good question in terms of time.
That's a great question. Yeah, I would say you should also include them as well. Consultants are actually probably, depending on how you structure them, you can put them even on the team page versus on the advisors or board. Ways that I've seen it done, the two ways I've predominantly seen it done is one, where it's a consultant that's sometimes kind of like maybe like a fractional CFO or CTO or somebody who still has a full-time job but may transition into the team later on when you raise money, they'll be indicated there as kind of like a part-time X, right? And they'll just kind of explain that this person's going to be on the team. Another way I've seen where they're just like specific consultants on product development, you can include them in the team page. The one thing I would include though, and this is just more of an IP question, you may get from investors, just ensuring that whatever the consultants develop, especially if they're like technical or engineers, that IP is owned by the company versus by the consultant. So that may be a question that comes up, but again, it's more of an IP question.
Thank you. And I just want to emphasize what Samer said. You definitely want to get permission of whoever you're putting into your deck. That is, that's relevant for a team, whoever you're kind of putting in as a consultant or advisor, as well as if you're saying strategic partnerships, brands that you're partnering with, things like that. Always make sure you have in writing permission from them, because it will be something addressed in the due diligence, and you don't want, I think that is one of the biggest things that can quickly kind of make your investment package move off the table, is if there's a credibility question. And you don't want that to be questioned just because of an oops factor of you forgot to send an email to get permission, although technically they, so you just don't want miscommunication in that regard. So highly recommend you kind of take the few minutes to kind of get agreement aligned with whoever is displayed on your investor deck.
That's a great point. And I would say even like going a step forward is that letting them know that you're fundraising, not just from the perspective, just kind of like having to make sure that no issues come up in due diligence, but oftentimes, especially these are industry experts that are also investing their time into supporting your company. They could also have relationships with other investors, angel investors, or they themselves might have capital to put to work. And so I would say there's ways to lean in on those advisors and other people that you're engaging, especially if they feel bought in enough on what you're doing to want to attach their name to it. Any other questions, or should I move on to the sample?
You can go ahead.
Okay, cool. All right, so this is it's a bit of a meme team page, but it was something that I was just thinking about because NFTs are all the rage right now, and I'm seeing a lot of it intersecting with athletes and entertainers as well. So I thought this should be a quick kind of satirical page on what a team page could look like. So as you can see, it's very actually simple, right? Like there isn't actually much complexity outside of the image, their role, and some of their experiences, and then logos. And the logos are actually surprisingly important, but it's something I see on almost every single deck as a way to just give some of that initial credibility to people, right? So, and also just for those of you that don't know, like non-fungible NFTs, non-fungible tokens are just digital assets essentially that that retain value and can be traded and bought and sold. It's much deeper than that. It's just a very basic thing, but this Non-Fungible Basketball Association is a company that sells NFTs, so digital assets representing NBA players that you can buy and sell. So the ideal team for a business like this are people with one, deep understanding of the NFT crypto industry, as well as a deep understanding of the NBA specifically and deep connections into the market. And then three, ability to build and scale brands very successfully, right? So the CEO, the person leading the charge is Steph Curry. You may have heard of him. He's two-time NBA MVP, three-time NBA champ. But more specifically, he has probably one of the deepest networks in the NBA, or is as deeply respected as you can be across any players, right? Like, he is in the upper echelon. So he is able to, as a person developing this brand, one, instill confidence in a team that he'll be able to execute. Two, he'll be able to have all the right relationships to be able to, navigate the NBA Players Association, the NBA itself, recruit all these athletes. He has that reputation and reach in a way that many others don't. Elon Musk, he's mad into crypto. He's kind of a meme lord, but specifically he's built multi-billion-dollar companies multiple times, right? And so he's able to, you can kind of look at him and see he can scale the engineering team to the point of being able to build and scale this company. He's connected to industry, and he can kind of keep the ball moving. And then Serena is obviously just deeply committed, deeply embedded in brand development, and would be the right person. So the team page actually looks kind of simple, but being able to highlight some of these key differentiators very quickly is a good thing just to catch their attention. Oh, sorry, I thought you were saying something, Blessing. Yeah, so again, this is the team page. If you were to take this as a advisors page, you would have, it would be somewhat similar. I would say the main differentiator when you have advisor, I would usually include 1 to 2 lines that kind of includes why they're relevant or why they would be helpful to you, right? So if you had an advisor, say that was Michael Jordan, for instance, right? You can obviously point to him being a owner of a NBA basketball team who can lead negotiations with the NBA on any marketing and branding rights for athletes, right? And you can call that out in the deck as specifically why this is a differentiator. And the earlier you are leaning into the expertise of your advisors and board is definitely a great way to be able to instill more credibility into your company. So finances and traction. As Blessy mentioned earlier on the call, I think, there's, it sounds like some of you are maybe potentially just starting out, like building out the product, building out your team, developing your business model. Some of you might already have revenue, have been in business for a while. And so this, I'm kind of orienting a little bit more towards those that are just getting started and don't necessarily have traction or finances to point to, right? So one thing that is helpful for you here on the traction slide is if you do have a pilot, if you do have beta, if you've had any sort of opportunity in which your product or service has been brought to a customer and they've engaged with it to some degree, I would include that, especially if it's something positive, right? So like, for example, another example, my roommate right now, he's starting a biotech enterprise SaaS company, right? And he's raising a seed round. And he's raising, he's an example of somebody raising a priced equity seed round. And they just finished their demo with a potential client, right? And so the client paid them a very small stipend for the demo. The demo went well, and now they're looking at a letter of intent for when the product is ready to go for them to roll it out, I think in the summer of 2022. That is something specifically that he's going to include in his seed deck to showcase that that there's evidence of product market fit. And for context, what product market fit means is just that the solution that you've developed is meeting the needs of your customers, right? And it might not be super pretty yet, it might not be super refined yet, but the customers look at what you're building and they can see that this will meet my needs. And if you continue to improve that product, you'll be able to expand, and like you'll be able to expand and reach other customers, right? So product market fit is really when, at like a very rudimentary level, the quality of the product itself is what is causing more and more people to join versus the marketing or sales spend that you're putting against it, right? You can't spend against a company that doesn't have product market fit. You can throw a bunch of money in marketing and sales, but you don't have that product market fit, it's all going to collapse. And this traction is really trying to look at to identify if you have product market fit. So identifying and including any information on betas, pilots, again, be very, I would say like transparent with where these things are, because in due diligence, a lot of investors will call customers, right? They'll ask for customer references before making decisions. And so it's good to include that. The other piece, and this is more of a kind of a pro forma income statement. I know that Blessy shared one with y'all, an example with y'all in advance, but this is really about projecting forward, right? And I would say every investor looking at the pro forma at a pre-seed or seed company expect it to be wrong. Like there's never, at least for me, I've never seen a deck where it was accurate. it's usually always undershooting it. But really what they're looking for is what are the underlying assumptions you're making that you think are going to have to happen for you to see this growth, right? And so one is like being able to project out potential revenue growth. And I don't know the different kind of models here, but if you have some sort of, recurring revenue type product, right? An enterprise SaaS product or whatever it may be, you can project like, this is the cost of the, thank you for dropping that, blessing. This is how much our price point will be for the product on an annual basis. This is going to be the projected growth that we're going to have as we bring on new customers. And as you're talking about new customers, you can like revenue growth, you can delineate that between new customer growth and then upselling of existing customers, right? So are you able to get your customers to double down even more in addition to bringing those new customers on? And obviously, when you start to get into the actual financial statement, you'll have to include things like the churn, so customers falling off, customers kind of like decreasing their spend with you, those things. But with these projections, this is the most rosy projection you can put, and it's just a math equation, right? It's just like revenue X the percentage of growth on a monthly or annual basis by customers. And then you also want to include gross margins, depending on your businesses. If you're like a software company, especially an enterprise SaaS company, they have expectations for what your gross margins are at different stages of your development. So like they expect gross margins to be relatively low at the pre-seed to seed level, but the idea being once you're hitting Series C, Series D, your gross margins are increasing sometimes up to 75, 80% or more, just because it sells it like you're just paying the engineers and you're paying the overhead. You're not paying for that additional kind of maintenance, or the unit cost is small to none. And then also including cost of goods sold and operating expenses. And that should also include salaries, right? So this specific slide actually ties in pretty closely to the next slide we'll talk about, which is really what's the follow-on actually is going to be the fundraise information. But this slide on exit strategy, and I'll actually pause for a second to talk a little bit about this kind of equity investments, right, in general. And then there was a question earlier about connecting with an angel investor. But I think just like fundamentally, and this is a big question for a lot of people, especially for folks that have started their company in the past, like have a company, you have revenue, and you're looking to scale. People make an equity investment with the expectation that you're going to sell your company. Because that's the only way they're going to get the return, generally speaking. There's different vehicles that we won't get into, but like generally speaking, they will get their money back when you sell your company. And the exit means it's an M&A, a merger with a bigger company, you IPO, you go public via SPAC, but that is the expectation that you will sell your company and the shares that they get will be returned to the value they get from it will be much, much larger, ideally 10x or more larger than the investment they put in. That also creates a lot of different incentives and pressure on you as a business owner for your business, right? Because if you're selling your company, that means if you're building your company to scale, a lot of times investors want to see you grow as fast as possible. It's not about profitability, it's not about sustainability. It's about how can you figured out a solution that's really interesting. How can we start to put money into you? And you hire the staff, the engineers, the salespeople, the rest of the team to be able to go out and build this product and build this company as fast as possible and then exit it, right? And for some people, that's what they want, that like they want to be able to just build, scale this company, have a great, hopefully financial return at the end and be able to either stay with it after they sell it within whichever who the acquired IPO is, maybe leave and start something else. But for a lot of people that aren't interested in that, this could create a lot of tension because it then puts you in a situation you might be at odds with your investors. And we'll talk a little bit about expectations with investors down the line, but just wanted to kind of create that reality that equity investments is a different kind of capital, very, very different from debt for those of you that may have taken on debt. And you should really think about what your goals are personally, as well as for your business before kind of accepting it. Now, as I talked a little bit about the exit. Now, the exit strategy, and this is something that I don't actually always see in a lot of pre-seed to seed decks, but when I do, I think it's very valuable. And this is valuable specifically because, again, the assumptions might be wrong, but what the investors are seeing is that, like, you as the entrepreneur are thinking about the different scenarios in which your business could be sold down the line, and to what level do you have to build the business to make it viable to be sold or to go on to the next level of investment. So for example, like one that I saw recently that was really good, it was this fintech company that I talked about. They showed that, like, there was a similar company serving a different audience that scaled, and this one sold to a public company, and they were at, I think, $75 million a year in revenue. They had, I don't remember how big the staff was. Their growth rate was X, and they had, like, strategically, like, captured this much of the market, and they were purchased at a multiple of like 7 times or whatever I don't remember the exact number, but 7 times their revenue, right? So, like, they were able to then go to say to investors, like, there are examples of companies like mine exiting in the recent future, and here is one example of it. If I hit those metrics, I think I'd be able to exit at that level. Also, here's another example of a company that IPO'd at this level of revenue, this size, whatever it may be. If I reach that level, that might be the way. Again, the assumptions isn't that, like, this strategy, you stick to it. But the idea is that you're able to then, you as the entrepreneur have this long-term vision, and you can align on the same page with the investor about what the potential outcome is for the company. So it's really helpful to see, and it also answers some of the initial questions and gives you more credibility that this person really understands what they're getting into. So the fundraise information. So this is usually, I see this near the end of slide decks, and this is really just like, how much are you raising and what are you going to spend it on, right? So I'm raising a pre-seed round, $500,000. I'm going to spend $250 on product development. I'm going to spend $150 on staffing. I'm going to spend $50 for just miscellaneous ops. I think that amount of money will give me 12 months of runway. I'll have to start to raise my seed round at probably, like, in 6 months from now, I'll be raising my seed round, but I'll have had enough traction and growth by then that I can go back to my go back to investors and raise money at a higher valuation. The best way I see this done is usually in a pie chart. It's percentages. The specifics of just, like, I very rarely see pushback from investors on the use of funds unless it's something egregious, right? But if it's something pretty straightforward of just, like, staffing, product development, beta testing, that's usually just like, okay, cool, you know what you're going to spend the money on, and more specifically, how long it's going to last you, and when you're going to start to raise that next round of capital. On this slide as well, for those of you that may have already raised capital, it's a good place to include names here, right? So just a few names. Individual angel investors, unless they're notable or they're known to the investor you're pitching, probably matters less. You can maybe kind of include, like, how much you've already raised is helpful, but that number changes so often, it's probably not great to put in a deck. But if you have, like, a venture firm or a notable angel investor and they agree, that's a good name to put here. So finally, just like some additional post things for consideration. And I started to touch on it a little bit, but Bless, I saw you unmute. Did you want to? Okay. So just some additional points for consideration is the post-investment expectations by investors, right? So once you take capital from them, as I mentioned, now they're expecting the return, right? They're not expecting it tomorrow. They're expecting to be in this for 5 to 10 years. Like, that's how everybody gets into it. But they're going to want to be reported to. So I see very often anything from monthly to quarterly investor updates, which kind of updates on product development, team, any new opportunities or strategic partnerships or betas that they've done, also any challenges that they're facing. And then also, most importantly, how the investors can be helpful. investors, once you have them on the cap table, are incentivized to see you succeed. And so you can lean into that, and you can, like if they have connections you want to access, if they know people you want to talk to, you can really lean into it. The next thing is follow-on funding. You're likely going to need multiple rounds of funding before you're able to really kind of like scale and potentially exit the company. So investors are going to want to know that you understand that and have a plan in place for the next round. So how long is the money that you just raised going to last? When will you need to raise your next round? Who are some key investors that you'd want to target? And then board management. Typically pre-seed angel investors don't take board seats. You might have some board seats taken by seed investors and VCs. But if you do, now it's probably going to be the first external board member you have within your company. And that creates a lot of changes. And so just being prepared for that is key.
Great. Any other questions for those who are on the call? We can actually unmute if you have any additional questions, if you would prefer not to put it in the chat and just ask. I'll give it a minute. Okay. Sounds good.
I had a quick question.
Go ahead.
Hey, my name is Elam. I'm with Delaware Limo. Our company is pretty far along, and we're looking. This is about a 30-year in operation. But the biggest question I came into this call looking to answer is whether equity financing or debt financing would be the best option. My answer that I've come to the conclusion to is that it seems like debt financing is better simply because we've already incurred all the risk in the beginning to kind of scale the company to this point. So I just wanted to hear like your opinions on like, is there ever a situation where an angel investor can come in and give just a debt financing to a company? For example, they might give a loan for, not like millions of dollars, but let's say $500,000 or something smaller, and just have like an interest, just have that be repaid within a certain amount of time with a certain level of interest. Do angel investors always ask for equity, or VCs always ask for equity, or do they have debt financing options as well?
That's a great question. I think echo's gone. Yeah, that's a good question. I think so. I haven't seen direct debt, but I have seen them use a different debt instrument. So I don't know if you're familiar with revenue-based financing, but revenue-based financing it's a loan, right? But it's structured a little bit differently. And essentially how it's structured is for companies that have already made revenue, right? And you're paying back the loan based on a percentage of revenue on a monthly basis until an agreed upon multiple is returned, right? So for example, say, I'm gonna just like throw out some random numbers, like say you take $100,000 loan, you agree upon it that within 2 years, you're gonna return back $150,000. And then, or it's usually longer with them, maybe like 3 to 4 years. And then on a monthly basis, based on your revenue, you pay back a percentage of that until you hit that 150K number. And so it allows investors to get a little bit more upside than a traditional just interest payment, while simultaneously it doesn't touch your equity, right? So you retain ownership of the company, and it has some flexibility. So if revenue is lower 1 month, that percentage payment decreases, and if it increases, it's you pay off a little bit more. So that's something that I would actually look into as a resource.
Yeah, that's a great answer. Thank you so much. I just have a follow-up question with that is, what type of you just went through your presentation of what an angel investor would like to see in a pitch deck and things like that. You did a great job of that. What would a company that's looking to do like a more revenue-based financing, what would they like to see? I'm assuming obviously strong revenues would be one criteria. Is there any type of companies or industries that investors usually choose this option for? Just to kind of just put a profile to the type of companies that receive this option of funding.
That's a good question. Honestly, I think your company could be a fit for it. I see it a lot more with like tech-enabled companies, companies with some level of recurring revenue or consistent revenue. So one thing that I would say to keep in a deck would be like, not only show your financials, but indicate how much of that is recurring or regular. So even if it's not a long-term contract, but you have consistent purchases or like contracts with different vendors, that's positive, because what they really want to see is consistency in revenue, clear growth trajectory, and stability within the company. So not too much volatility as far as like seasonally or whatever it may be.
Yeah, I would say the contracts help. So if you have, I mean, because we do, just so that everybody knows, the Enterprise Center has a CDFI that does do lending. There have been certain times there's been a contractual kind of structure, but I mean, they typically don't do that. But I think contracts are a good way, especially if it's a signed contract with an established, you know, the customer who has shown that they are already generating that revenue. I think that's helpful, especially because it's based on a revenue share. That's the key question, is how can your revenue be guaranteed as much as possible? Contracts typically are helpful to kind of verify that and back it up. Let's see, we have a couple more questions that are coming through. What is the best cap raise strategy for a tech startup pre-revenue with proprietary IP that's patent pending and a projected MVP budget of 28 million?
That's a good question. I think, so for the really capital intensive companies, say if it's, I feel like I see this in biotech, medtech, clean tech a lot. You have to go to really strategic investors, because you need a lot of capital initially to get it moving. And you probably have a long time path to get there. So I would say going towards, like, depending on your industry, I'm not sure what it is, but like, you know, yeah, VCs, a lot of early stage VCs are looking at it, medtech VCs as well. There's also non-dilutive opportunities if you're like, say, in the sciences, like NSF and NIH have SBIR and STTR non-dilutive grants for people developing specific technologies. So I would look for those non-dilutive things, but you know, for more capital intensive things, it usually needs to go to more strategics versus VCs versus individuals.
Great. So we have a couple other questions I'm going to address. Evelyn asked the question around, would federal or state contracts count? I believe that's in reference to the revenue share. The answer is yes, for sure. One of the things I would recommend you be prepared with is understanding the payment cycle of those contracts. So, you know, does your contract say that the customer will pay in 45 days, but functionally they only pay in 90 days? You want to be prepared to address that as you're kind of going in, because again, it impacts your revenue. Like, you technically have the revenue number, but do you have the cash in house to make payments? So when does that cash come in terms of accounts receivable? So just be prepared for that in terms of being able to address that question when you have contracts in place. It just came to mind as you were talking about federal and state contracts. Sometimes those can take, depending on who you have it with, it can take a little bit longer to get paid. So the other question around how can you become a member of the Enterprise Center? Let me start with sharing the MBE Equity Multiplier webpage. That is this specific service. And the reason why I say that is the Enterprise Center has various services available. This specific service is tailored towards the equity financing side, prepping for it, giving you one-on-one consultation support, working with experts in the space. So if you are interested in that, please do go to our MBE Equity Multiplier page, and there's a button on top where you can fill out the intake form, and that is the best way to engage with us on this side of the service. If you are looking for other services through the Enterprise Center, i.e. the lending side or our procurement side, so we have a whole team dedicated to working with businesses at different ranges of revenue, but more so focused around how do we help with procurement opportunities? How do you help you prepare for accessing those procurement opportunities, but then also facilitating them? So if you want to learn more of that, I will tell you in a second my email address, and you can just directly email me. But For those of you interested in this service, which again, I'm going to remind you is free for all minority businesses, it is available to all minority businesses across the US. So please don't hesitate to share it with anybody else that you know that you think would find it relevant. But please go on our webpage, complete that intake form, and we will walk you through the next steps. Also, our webpage will have information on our upcoming workshops. So we will continue to do workshops on different topics. The other thing that I wanted to let you know about workshops is we had a question on, is there a pitch deck template that you can use? I actually shared in here, if you go to the chat, I'm going to reshare it again. It's called the investment brief template. And that is a good template to start with. And I will be hosting some smaller group workshops in the sessions in the next week or so, where you can jump on and I will walk you through that template and we can kind of dive in more specific to your business to say, where would you find some of this information? Kind of let's talk through it and dial through, kind of walk through the sections and kind of just discuss through it and see if we can kind of help you get started on the investment brief template. But that is a good way to get started on the content that would eventually translate into an investor deck. And you want to make your investor deck, although this presentation kind of walked you through the structure, but you want to make it as personalized as possible. You want it to be unique and different. So I would say, you want to use your own touches to it, your logos, your colors, your branding colors. There are templates out there like Tia, but I would definitely leverage that investment brief template as a point of start, and then we can work with you with our consultants to help you through the process. Okay. So
sorry to interrupt, Leslie. I actually have to jump to another call real quick. Apologies. I don't want to wrap it up for you, but just want to thank everybody for your time. Feel free to share my email, folks that want to follow up. But thanks again for tuning in.
Thank you. Thanks, Amar. Appreciate it.
Thank you. Leslie, this is Dal. I'm not seeing the template you mentioned in the chat.
Give me 1 second.
Oh, okay.
Let me share a couple.
I just want to make sure I hadn't missed it.
I will share it again.
Thank you.
I know that with every chat, things get moved over and up. So give me 1 second here. I'm going to share that email address. So if any of you need to get a hold of me, you can reach me there. And then here is the template again. All right. Any other questions, guys? I know we're over time, so I don't want to keep you too much longer. All right. Have a great evening, and we will hopefully see you at future workshops and engagement with some of our other services. Have a great night. See ya.
Thank you, Blessy. You too. Bye.
Bye.